Welcome to SB Talks. Today is Wednesday, December 6th, and today we are going to be discussing yesterday's RBA rate announcement, the rise and fall in US long-term bond yields over the last 8 weeks, and 'tis the season for a Santa rally. I'm joined, as ever, by our trusty Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Let's start domestic for this week. Yesterday we had the latest meeting of the Reserve Bank. After their rate increase in November, we saw them pause yesterday, so thankfully for the Christmas season we didn't get that Christmas rate hike. Was there anything further you could glean from the statement?
No, I mean, the key paragraph, the final paragraph, was essentially unchanged. It continued to talk about whether further rate rises or tightening is needed to get inflation back to target in a reasonable time frame is dependent on the data and risks. So that's largely unchanged. There was a couple of things to note in the statement. They did talk about the data that's come out since the November meeting, namely the monthly inflation print, which they said was kind of in line with expectations, but they cautioned it really only measured goods prices. So the thing that the RBA have been talking about recently that's of more concern to them is the services inflation, and we won't really get a feel for that until the official quarterly CPI number comes out at the end of January in time for the February meeting, which is the next meeting. So that was one thing to note. They also talked about wages being a bit higher, but that largely as expected due to increases in award wages and the Fair Work decision. But yeah, overall, I think there wasn't too much to be taken away from it. There's still a question as to whether they might have to do more.
What's the market pricing in at the minute? And I appreciate that can sort of really wax and wane, but what is it pricing in and if so, when?
So there's not much of a rate rise. There's 8 basis points of cuts by June, so no real rate rise.
Right.
I think there's a few basis points in potentially early 2024, and then, as I said, 8 basis points, so about a quarter of a rate cut.
So that's kind of the market pricing and no action likely probably from here. As it sits today, and I appreciate that can change quite a lot.
The economists are largely sort of, there's a diversity of views. There's quite a few that said they're done, and then there's a couple still saying that they might have to do more. So I think it's really data dependent.
We do seem to go in this cycle. They do a rate hike and everyone starts to get into the question of do we have another one or one more beyond that? Then we go through a sort of a slightly, let's call it, slightly better period for data and a pause month, and then suddenly everyone sort of starts to ebb back into the we're done camp. It's really too soon to tell. And as you said, that data that we will get ahead of the Fed meeting is probably going to be pretty pivotal at setting the direction for the first half of next year.
We are filming this before the GDP numbers come out later this morning. I think that's another thing that the RBA has spoken about is just overall economic activity being still fairly strong. So I think that's another data point that they'll have under their belt when they meet in February.
So that's a good thing. We're still seeing that resilience in the economy despite the rate rises that we've had to date. But it will all feed into the decision making for the first half of next year. Now, Australia, it's been sort of a little bit more tepid on that front. Internationally, we've had quite a wild ride across many asset classes and indices across October and November, and it's been heavily led by the rise and subsequent retracing of US long-term bond yields. Let's just recap where we've seen those yields get to and then sort of what's retraced.
Yeah, so we've essentially done a sort of a 180-degree turn over the past few months. So yields spiked, and we've spoken about this on the podcast previously. We saw, for example, the US 10-year yield get from sort of I can't remember where it was, in the high threes probably in sort of, August, something like that. And then it rose to close to 5%. It briefly touched 5%.
Which was the highest level we'd seen since before the GFC. So that really rattled markets somewhat.
And that was on the 19th of October. And then since then, we've seen yields fall across the yield curve, not just the 10-year, but also the 2-year. So by about 70, 80 basis points. So the US 10 years is 417 today. So that's quite a big fall in bond yields from that 5% level not that long ago.
What's driven that, as much as there's probably a bit of sentiment in it, but what does the data led that?
I think there's a few things. Firstly, there was a few question marks about why yields, and particularly long-dated yields, had risen so much. And that was, we've spoken about that also previously, supply concerns. And those have abated a little bit. So, for example, the US Treasury has been issuing more shorter-dated Treasury bills rather than longer-dated bonds. So that's kind of reduced some of that sort of short-term supply pressure. I think the other thing, as I mentioned, was the inflation numbers have been quite good, really coming down fairly quickly. So that's definitely helped the narrative that, we were in a higher for longer environment and now maybe we're not in a higher for longer environment.
We have probably quite a contrasting narrative there in the US versus here in Australia, where we're still working out how much further we have to go, and then any rate cuts are probably still quite some way off.
Yeah.
US excitement, borderline giddy excitement towards the potential in rate cuts coming next year is definitely built in the last 6 or 8 weeks.
Oh, even in the last few weeks. So we've had the Fed's Waller speak, I think, a couple of weeks ago, and he's normally quite hawkish, and he was saying that if inflation continues to come down over the next 3 to 5 months and that they get confidence it's sustainable, that they would be in a position to cut rates because inflation has fallen. And that's quite different to a lot of the other messaging out of the Fed. It's like, oh, no, don't bake in any rate cuts, So
and the Fed's been probably a bit nervous regarding these second factor sort of inflation things that could come through, follow-ons from people having a bit more surplus income then into their pockets. So they've been talking it down. They've been trying to put, a lid on things, and had been helped by those bond yields being so high, but now that one assistance is very rapidly going the other way.
Well, that's right. And so Chair Powell last week said, oh, well, hang on, it's too early to talk about rate cuts. But the market had already kind of latched on to the whole idea that if inflation's coming down, so for example, the core PCE, which is the Fed's preferred inflation measure, is 3.5% at the moment, and the cash rates call it 5.5%. So we have real rates, which is the difference between those two, of about 2%. So the argument would be that as inflation continues to fall, they don't want real rates to go up. If you kept the cash rates steady, then the real interest rate would be going up.
Yeah.
So that's hence the argument that they would be in a position to kind of lower the cash rate as inflation falls, and it would still be the same kind of restrictiveness.
Same level of handbrake on the economy. So it's a bit of a delicate balance there. But that, as the US bond yields sort of trickled back down the other side of the hill, or probably flowed down at quite a rapid rate, the markets got very excited.
Yeah, so people talking about the Santa rally.
Yeah.
So what is the Santa rally? So December happens to be the month of the year that is most likely to see a rise in the US stock market, based on data going back to 1945 for the S&P 500. So in 77% of years...
Is that statistically most common to have a rise, or statistically largest rise?
Well, I don't think it's necessarily the largest rise. Right. It's just the month that is most frequently there's a rise.
Positive
so
month.
77% of years there's
December
a rise.
Is a positive month.
Is a positive month by about 1.5%, which is not a huge number on average, but it is still, it's... People talk about the Santa rally, so we will have to see whether that plays out again this year. But certainly markets are very kind of happy with what's going on. So the S&P 500 made its year-to-date high last Friday. I think that the German DAX is at an all-time high. So this sort of pullback in bond yields has really put a rocket under stocks as well.
Got people excited that we're at the end of this rate hiking cycle and starting to look beyond the immediate economic picture. Let's talk to that economic picture, because there's been a lot of the conversation, or we go back 6-12 months ago, it was all about the narrow path to the soft landing. As we've talked about, we're seeing terrific economic resilience here in Australia. The US economy is still remaining quite robust, regardless of some of those other factors we discussed before. What are you seeing from different corners? What are the predictions for 2024 in terms of the ability for major economies to avoid a recession, or certainly hopefully avoid a deep recession, with the lingering impacts of rates and the rises that we've seen up to this point?
So the consensus view is that a global recession is avoided. next year. So that's quite different to where we were a year ago, where everyone was saying a recession was quite likely, given how tight monetary policy had become. So no one's really calling that. There's a few economists saying, the recession's delayed, not cancelled. And so they still have 2024 as a US recession.
And a more cyclical type recession there in terms of a sort of a narrower...
Yeah, I don't think anyone's saying it's
shallower.
It's going to be particularly deep. We don't have the financial imbalances that we had before the global financial crisis, and there's still a degree of pent-up savings that haven't been fully exhausted. So I think there are still a few calling for a recession, and they just point to history. Every time you've had this kind of increase in interest rates, it's always led to a recession. But that's certainly not our view, and it's not the consensus view. The consensus view is global growth to slow to about 2.5%. That's kind of just above where people kind of say a global recession's anything below that. Long-term growth for the global economy is about 3.5%. So there'll be a slowdown next year, but certainly not a deep contraction or anything like that. The US is expected to slow. I think the consensus view is around 1% growth.
Right.
Next year, their long-term kind of potential growth is like 1.8. So it's a slowdown, but it's not negative.
So you're firmly in team soft landing at this stage?
I'm in team soft landing. I mean, I think things are a bit more, maybe not as good in Europe. They're certainly more sensitive to interest rates, and then sensitive to the global manufacturing cycle and to what's going on in China. And
it's quite a different demographic position there as well,
in
terms of aging population, and they don't have the immigration factor that we have here domestically and in the US. So probably the inflationary market was probably less likely to persist there, bar obviously the horrific situation that we have persisting in Ukraine and the flow through to other parts of Europe from that.
Yeah. I mean, certainly that energy price spike they had last year is well behind them, and they've built in a degree of energy resilience this year that should see them through the winter without the same sort of spikes in energy prices that they've had. So that's positive, but the economy there is fairly soft. I mean, it's kind of growth is around zero or slightly negative at the moment. Yeah.
So more challenging environment there. Now we will catch up again for one more podcast this side of Christmas, and we will take that as an opportunity for your year in reflection and your outlook for into 2024. So I will not ask you for any predictions at this point, but we'll look forward to those ones next time. For now, thank you very much as always, Nick, and thank you to all our listeners. Take care.
Thank you. Take care.